Hey guys, it's Chris Dunn. Even though I've done pretty well as an active investor over the past couple of decades, I've made pretty much every stupid mistake you can imagine. And in this video, I want to talk about some of my most expensive mistakes that have literally cost me millions of dollars over the years. So hopefully it can save you some money in the future. So these are all mistakes that have cost me millions in either lost capital, so meaning I had money and then I lost it, or unclaimed profits. So I had profit on the table that I didn't take and then it was gone. So hopefully you can take at least one of these lessons to heart. Who knows, maybe it could save you thousands or even millions in the future. Now, as always, this isn't personalized financial advice, and this is really just for education purposes only. Now, there are a ton of mistakes that you can make as a trader or an investor, but the key is to try to make all these mistakes with a small amount of money, right? You wanna have what's called like market tuition, where you learn and maybe you lose a little bit in the beginning, but you do that with a small amount of money, because some of the mistakes I'm gonna talk about are so important that they could literally make or break your career and like take you out of the game. So expensive mistake number one is what I call death by 1,000 cuts. And this is either over trading or day trading. And I've talked about day trading a lot in past videos and how the data shows that in today's competitive landscape, almost all day traders lose money. Now, day trading is where you're hyperactively trading in and out of positions within the same day, right? And it used to work really well when the markets were less competitive, but in today's markets, it's basically a fool's game. And overtrading can happen to new traders because of that excitement that you get when you're just getting into the markets, right? It's like when you first sit down and you start looking at markets, you want to do stuff, right? You want to start buying and selling things. And the idea is to keep it simple and not let your excitement get ahead of you to where you start making a whole lot of bad trades. And this is, in my experience, what I see to be the #1 killer of new traders and investors. So don't overtrade and don't day trade. In the first 10 years of my career, there were some really good market environments for day trading, and some of my early mentors were professional day traders at the time. But again, in today's markets, what I've noticed and where I've made mistakes is just wasting a lot of time and having death by 1,000 cuts trading in and out of stuff. So my motto today is to trade less and profit more and go for the bigger, less frequent moves. Now, expensive lesson number 2 is don't be a piker. So this means not putting enough chips on the table when I find a trade or an investment that I'm really confident in. So the internet defines a piker as one who bets with only small amounts of money. Now look, hindsight is always 20/20, but I've had some investments where I spent months doing research, and for whatever reason, I only put up a pitiful amount of capital, sometimes leaving millions on the table. For example, my friend started a software company and I was able to invest in his first 2 VC-backed rounds. And even though I had a ton of conviction in the investment, I invested like a wimp. And fast forward to today, the company's now worth over $100 million. And to give you an idea of how I think of this, when it comes to angel or startup investments, I look at things in unit sizes. So like 1 unit is like 25 grand. And the absolute minimum check that I ever want to cut for a business is $25,000 to $50,000, because anything less than that just really isn't worth the payoff if it does succeed. Well, in this case, I didn't even cut a full 25K on my first investment. I did like half that for some reason. And so the reason why I'll never invest less than 25K is, again, I'm not going to do the work and track the business and put in all the time for that small amount of money. It needs to be the right position size. So I like to think of it as like growing a pair and putting money on the line when the right opportunity comes along. Now, lesson number 3 is don't be a pig, or don't oversize your positions. So just like you can undersize an investment, you can also get too aggressive and put too much on the table. Now, knock on wood, to date, I have not had any kind of catastrophic, massive loss that's wiped out a major percentage of my capital, but I have been in some situations where a position grew too big for comfort. So for example, in 2015, when Bitcoin was in the depths of despair after the 2013 bubble, I put a big percentage of my net worth in Bitcoin. Now, fortunately, that bet paid off massively when Bitcoin went from $200 to over $20,000. But had Bitcoin gone to zero, I would have actually lost well over half of my net worth at the time. So sometimes it might make sense to size a position like a pig, but only if you have a ton of conviction that it's going to work out and you truly accept the downside risk. Where a lot of people get in trouble is they just swing for the fences and they're like, all right, I found an investment, I want to get rich quick, so I'm just going to put all my capital in on one deal or one trade, and that usually is a really bad idea. Again, you might get lucky, but you got to think in terms of probabilities, and if all it takes is one trade or one investment to take you out of the game, that's putting yourself in a lot of like unnecessary risk. Now, expensive lesson number 4 is not having faith in your thesis or closing too soon. Now, if you spend time researching an idea and then you step up to the plate and you put your risk capital on the line, one of the worst things you could do is close the trade or get out of the investment too soon. Now, this can happen because you let price action on a chart scare you out, or maybe somebody offers to buy your equity in whatever investment you have for a fraction of what you think it could grow to. But basically, closing too soon means you put in the work, you put the money on the line, and then you get scared out of it. So for example, in 2016, I had a couple of altcoin trades that were growing way bigger and way faster than I expected, and it kind of freaked me out. And so I took profit too early because I didn't believe the projects could be worth so much. I underestimated what crypto could do. And some of those positions grew to like mid 6 figures where I could have made like several $1,000,000 on each one. And so the way that I like to think about this now is I want to stick to my original plan and then scale out into strength. One thing that I've realized over the years is like I have no idea how far Bitcoin or an altcoin or a startup investment or a stock or even a real estate deal, how profitable things can become. Look at Tesla, like going from a couple $100 to a couple thousand, right? And then doing the split, things like that, right? Like markets can surprise you at how fast and how big they can grow. And so for me, I've just learned the hard way over the years that instead of trying to guess where the top is, I'll just predefine where some profit targets are that I'm going to take profit along the way. And then I leave what's called a moonshot runner, where if the thing just goes crazy beyond my wildest expectations, I'll have some skin in the game, right? It won't be the full position that I had initially, but it could be significant enough to where instead of maybe making 50 to 100%, maybe it's in the multiple thousands of percent return on investment, right? So again, just the big lesson is to stop guessing. And if you put the work in and you make the financial risk, stick with it and let it work. And as usual in investing, there's always an opposite side to every piece of wisdom. So just like I said, one of the big mistakes is closing too early. Well, big mistake number 5 is don't be the last one at the party. Meaning don't close too late, Just like you can jump the gun and close too early, you can be like that guy at the party that just doesn't really know when to wrap it up and head home.
Oh, what a loser!
Or maybe some of you guys have experienced this where you hear of, either a stock or a crypto project, you get in early and you think it's gonna go to the moon, and then, it goes up 500%, you don't take any profit off the table. You just watch your account and you're like, oh my God, I've made a life-changing amount of money on paper, but you never end up taking profit. And then you see the thing go to the moon or almost to the moon and then right back to where you got in, and you basically left unclaimed profits on the table, right? So again, that's why it's kind of that balancing act of taking some profit, but not closing too soon, and then also not being like the drunk guy, the last one at the party that just doesn't know when to wrap it up. Now, mistake number 6 is think before you play. The mistake is not predefining risk before you get into an opportunity. So let's say that you hear of a trade or an investment that sounds really exciting. Could be a stock, could be a crypto, could be a startup. It can be really easy to get hypnotized by the story and only thinking about how much money you can actually make. And then the mistake is made when you ignore the downside, right? So for example, in high school, when I started investing in stocks for the first time, I remember hearing about a pharmaceutical company that was developing some miracle cancer drug. And I was basing my profit models based off of the drug actually saving millions of lives. It sounded great. I was like, man, if this thing works, I'm gonna be rich. But I didn't stop to actually think about the reality that a majority of cancer drugs don't successfully make it through all the trials, right? A lot of them fail and a lot of pharmaceutical companies go bust. And so one day I woke up to some terrible news that the drug failed one of its tests. And then I looked at the stock chart and the stock was down like 98%. Basically, the company was dead. You know, the company's life was this particular drug. So that's when I learned the value of quantifying the downside risk before you get into the trade or the investment. You know, what is the worst case scenario? It's called like a pre-mortem. Like, if this thing's gonna die, why is it gonna die? And if it's gonna fail, what would that look like? And how would that affect my position? You know, a lot of people just wanna think about the upside, but really wise investors focus on the downside. If you control the downside, sure, the world could throw you black swan events and curveballs, but for the most part, you're not going to get taken out of the game. You're not going to get hurt too bad, okay? So now I'm able to go into investments truly accepting if an investment or a trade has the risk of like 100% failure, right? That's how I look at a lot of new crypto projects, is that most of them are going to fail, and whatever capital I'm putting in, you know, it's likely that I could lose all of that, right? So I size my positions accordingly. And now lesson number 7, the final lesson, is don't be a flip-flopper. What that means is don't let what should be like a short-term trade turn into a long-term bag hold, okay? So a bag holder is an investor who holds a position that decreases in value until it descends into worthlessness, right? So if you get into, say, a cryptocurrency and it's worth 10 bucks and you're like, okay, if it goes down to 8 bucks, I'm gonna get out of it. And then next thing you know, you're like, oh, I'm gonna give it a little more room and a little more room and a little more room. Next thing you know, it's worthless and you're just stuck holding the bag, right? So sometimes publicly traded companies will go into a death spiral. And usually the CEO is going to come out to try to tell a story to reinstill faith and confidence with investors. But if the company fails to deliver on their promises, the stock can continue just to sell off over time. And one example of a stock that trapped a lot of bag holders is GoPro. And if we look at the chart, you can see that after its IPO, it had a few months of growth, but then quickly went into a multi-year death spiral. Any investors that didn't see the early warning signs of trouble quickly found themselves holding the bag of a struggling company. And in the past, I've let some trades turn into long-term bag holders earlier in my career, and nowadays I'm much better at cutting losses quickly when there's signs of trouble, right? And really that comes down to ego and just recognizing that if a position doesn't go according to plan, that's not a hit on your ability as an investor. It's just, you know, it happens. It's the real world, right? So there you have it. 7 of the main ways that I have lost millions over the years. Hopefully you can take away some wisdom, maybe just one of these things that can save you money in the future. And so one of the questions that I just wanted to ask you guys is, what is one expensive lesson that you've learned around investing or trading? How have you lost money and what lessons did you take away from it? So yeah, share that in the comments below so we can all learn from each other. So if you like these types of videos, ever so gently give that like button a tap. If not, aggressively smash the down button. I don't care. Either way, just let me know what you think. Also, feel free to share this with a friend if you know somebody that could use some help. And as always, thanks for watching, and I will see you in the next video. Take care.